Mirrors are windows into other universes, aren't they?
No.
My mate Paul says they run on quantum power, and that's why you can see into an alternative dimension in which everything's the same as our realm, but backwards.
What does Paul do?
Well, he worked in a tennis ball factory where he had to catch the tennis balls, but he was fired from that. Now he's unemployed. Sorry, am I wasting your time?
Yeah.
Mirrors are windows.
Okay, let's talk about credit cards and the crap out there around credit cards. What matters, what doesn't matter, or people who actually claim that they know. Okay, I've got some questions here from my team, and when I walk through it again, I've just finished, finished work for today, and I'm the CEO of fintech called MoneySave. And we produce Oroka rings. Oroka are payment rings. So that means we're the first across the market, across banks. We're still talking to banks at this stage, but we're the first to actually launch this globally. So we're talking to your banks today. If you want to deal with a payment ring, also we have a payment ring and fitness ring together as well. If you want to, order these things, you can come to us, www.oroka.com. Okay. We're going to talk about credit card and all the myths out there. We're trying to dispel as much as possible, especially for myself, who I'm doing this right now. I'm not a promoter, I'm not a fintech guru or anything. I'm not a coach. So I want to talk about specifically what matters from someone who's worked in this for 20 years. So first things first is credit cards are used for rewards. That's true. So if you use a credit card for rewards, it's good when you use them to get rewards for flights, for discounts and things like that. However, the people saying these things, if you look at their profile, they're rich. Okay, they're loaded. They've got loads and millions of books and courses and YouTube followers. Okay, that means they're not making their money from there. That means they're not like us. Yeah, they are not like they are the 1% at this stage because they make so much money, no matter how much they claim. They make a lot of money, then therefore they can afford to use these things for rewards. And the average person is behind. Okay, the average person I can tell you within a year is at least behind on their payment, or has gone overdraft at least once in a year. That's average. If you don't do that, then you're good. Okay, take it that you're in the minority. Yeah, and that's what's key, and that's what's risky here. So celebrities, a lot of influencers talk about this as well. Hey, you're using this for rewards. That's true, but not for the average man. So please stop selling credit cards as only used for rewards. The average person might use it for rewards, but they fall into that trap of a debt. They fall into the trap of paying interest that they shouldn't do to their bank just for extra cash. Okay, so let's watch out for that one, please. That's false for everyone. It's true for some people, it's true for the 1%. Okay. Next point, carrying credit cards, carrying a balance boosts my credit score. That's what I heard somewhere as well. I've seen a lot of celebrities that say this as well. That's not true. So if you carry a balance, then it racks up interest. So, and that's the idea. That's what banks want to push. Okay. Banks, again, if you think about it, who are you paying interest to? You're paying interest to a bank. Okay. That means a bank wants you to carry interest. That means anyone who's selling you that, who's saying that to you, is actually in part of this as well. They want to make sure that they make money one way or the other. And how they make money is also through banks. And banks then charge you interest on it. So please carry an interest. While it helps your credit score, as long as you pay it on time, it's not the best of interest. Okay, that's one thing. And it's not the, how should I put it? Yeah, it doesn't help your credit rating as much as you think. What would help your credit rating if you actually pay everything up front on time, without carrying the balance? And if you look at what the balance is, so a balance on a credit card, I can tell you the average APR for a credit card these days would be about 20%. And that doesn't go up or down. Okay. That means when things are good, so when the interest rate, the interest rate across the ECB, the interest rate from banks to banks go down, it doesn't go down for credit cards. It stays up. Okay. When the ECB or the Fed or any central bank cuts the interest rate, they cut the interest rate, but they don't cut the credit card rate. Why? I'll tell you, because the credit card rate carries a premium. So people who default on the credit cards or who default on their payments, it affects others. It's like your insurance. If a lot of people are claiming insurance and they're forcing the insurance premiums to go up, then they are. That's the truth. If they claim a lot of insurance, the insurance have to pay it. The insurance reinsurer has to pay it. Someone has to pay this. And guess who pays eventually? It's the customers. Every customer who's still there. The same thing with credit card. So when the credit card rate, like default rate dropped around in 2019 when people just stopped paying, and then there was a huge stimulus that came in, which people, by the way, still didn't pay their credit cards with the stimulus that came in during the COVID. And when that happened, I think a lot of people, and the rates went up across the board for credit cards, right? And that's always the case. So please watch out for that. That doesn't help. And please don't listen to that. That's absolute crap. Then the other point, APR doesn't matter if you pay it off on time. Again, that's not true. So your average APR on a credit card, it's about 20%, which is really, really high. Okay, if you compare that to a loan is 5-6%. Okay, that's a good rate. But a worst rate, no matter how bad you are, it'll be about 6-10%, 6 to 10% max across the board. So what that means then is really you want to make sure that you reconfigure any credit card debt that you're paying and actually turn into a personal loan. Because your personal loan is actually about 5-10%, 5 to 10% max. While your credit card will definitely be sitting at about 20%. Okay. So you don't want to pay that month to month or carrying over that debt. Because a huge debt on 20%, 24% APR. APR is what you're paying annualized. Okay. Even though they claim it's only $100 a month, if you annualize it, it goes up to about 10% and was still about 20%. So that's one thing to watch out for. I heard this as well from some of my customers where they say, "Hey, I've been pre-approved. Why don't I have the credit card? Why don't I have the mortgage?" So a pre-approval is just a simple check. Most banks do this. So what that means, they just look at your profile, they look at how much you have, they do a soft credit check, and then it looks like it's passed. Okay, but that's not guaranteed that it's passed because it still has to go through a credit risk team, and they have to look at the risk appetite that they have as a bank. They also have to see the exposure they have. So the exposure is basically how many people they have in that area, how many people they have within that facility. So for instance, they have a lot of credit cards that are exposed to the Dublin region in Ireland. Okay, if they do that, then guess what? They're not going to lend to a lot of people there then. So that's important where banks look at all that, and therefore you can be pre-approved for a bank product, but you're not eventually approved at the end of the day. So that's another one. The other point then is, okay, buy now, pay later is not real debt. Here's the point. It's true. Buy now, pay now has been very good, but so buy now, pay later, BNPL for short, has been good for the market. So it helps you because again, we do it. Okay, I'll tell you that we do it because if you got a good credit rating, okay, and you want to be able to get a product and pay later, that's okay. It's almost like a credit card. They said they splits it out into about 3 months in general, 3 to 6 months. It's always a short term. Some countries may allow a bit longer, but across the EU and US, some parts in Asia as well, they limit that window. And that's important because at the end of the day, what you want to do is make sure that the BNPL is short enough so that you're paying later is not a debt. So what that means then is you want to try and make sure that these people can actually pay. So you look at the affordability and make sure they can pay. But it's still an obligation, so you need to pay it, okay? So what that means then is you have to make sure that whatever you borrow is small enough, okay, and then you can pay it. Otherwise, it impacts your credit card, so your credit rating. It impacts your credit rating and dips the score, so that you're better off just going for a loan as opposed to going for a BNPL. There are a lot of agents that have done so well over the last few years. Obviously, we know about Klarna; they've done very well. I know quite a few guys as well who are doing well at the moment, but at the end of the day, it's still a credit card, except it's a smaller, much more reduced exposure. It's not as high as any of the other credit cards that have an outstanding balance of about $5,000 to $6,000. Then the last point then is basically, should I, when I spend my credit card, should I treat it as bank's money? So a lot of people have said this, right? So a lot of celebrities, I'm not going to actually I'll mention that a lot of mostly real estate gurus, okay, and a lot of business coaches, okay. Here's the point: these guys have not worked in a bank before, so be careful when people say that, because they've got 5 million followers, doesn't mean it's true, okay. So what that means then is, please guys, be careful when people talk. Just know that's not true. So if that's the case, that means everyone should just be spending the bank's money, but it's not the bank's money, right? When you default, you know how serious it is. It's your money. Okay. When you spend your credit card right now, you're spending the money right now, but in the future, it's going to come back. Okay. You have to pay it in future. And that's the fact. Okay. So be careful and know that when you spend your credit card, it's your money you're spending in the future, and you have to pay the bank back. And the bank is almost, and I feel, you should treat the bank as a mafia. So they give you this money and say, pay me back in the future. Don't worry about it. But in truth, they want to make sure that you pay. They want to make sure you default. In fact, a typical bank would expect a default rate of about 5% to 10%. That means if you have 1 million customers, 5% of those 1 million customers will default. And that would mean that the interest goes up. And that makes money for the banks. If you look around and you see a big bank with all the tall buildings, who do you think is paying for it? They're paying for it from fees. And the fees are not from people who are paying off their credit cards every month. Okay, so that's the truth. So when a celebrity or whoever, an influencer, business coach or guru tells you, "Oh, use your credit card, because it's the bank's money," no, it's not. It's your money, and you're walking on thin ice. They're hoping. Look, I think during the winter that freezes. I think right in Switzerland. So if that freezes, right, you expect people to walk on it. And if you walk on it, you're walking on thin ice. At any point, it could sink. Small percentage of people would sink in that. That's what the banks hope for. Okay, so be careful with that one. And then the other point, just speaking about debt as well, is also mortgage. So mortgage it's a tricky one. So mortgage is a debt. It is rent. You're paying the landlord's rent. That's a tricky one because I think you're not paying the landlord's rent. You buy a house. Okay, if you buy a house that you live in, right? It's a consumption. You're consuming it. You're using it. It's as much as me buying my rings. When I buy my ring, am I paying rent or I'm using it? I'm enjoying it, right? I'm consuming it. It's good. I want to use it. That's why I bought this ring. Okay, it's convenient. I tap, I pay, and I go. Okay, that's it. Same thing as when you go to a restaurant to eat. If you go to a restaurant to eat, it's the same thing. You eat in a restaurant, you've eaten the food. Are you paying the bartender or the owner's rent? Yes, you are, but you'll get more value from that. Yeah, that makes sense. So in truth, if you look at the house then becomes same thing. If you buy a house that you live in, I mean there are cases around this. Number one, if you buy a house that you live in, then you're consuming it. Okay. You should not think about it that way. You shouldn't think about it as debt. You should think about it as something you're consuming, you're living in. And eventually, again, I'm not a fan of this, right? But eventually about when you're 60, that's your entire life. When you're 60, you would have finished paying the rent. And when you're done paying the rent, guess what? It's your house. Okay. And in that case, you can then turn around and say, I've finished paying for this and it's now my property. Again, as soon as long as you keep paying the council taxes, all the government taxes that are due, and then you can pass it on and pay inheritance tax. It's a different argument to be said another day if it's really your house when you're done. But I think the point there is the fact that when you buy a house, you're consuming that house. It's for security, it's for safety, and therefore it's not debt. You're using the house. On the other point, then, if it turns out that you're paying someone for a house, and then you have to look at the value of the property. So if you pay for a house in, let's say, New York, okay, now you're paying for a house in New York. What that means then is the fact that you want to be in New York, you want to be in a metropolitan city. It opens up opportunities for you. Okay, you've got opportunities where you can live, work, and get the best roles out there. Therefore, you're not really paying someone rent. Actually, I can tell you, in the last few years, it's been cheaper to rent than to buy. Therefore, you're paying a rent, but you're paying the rent so that you can have the connection, the opportunities to meet people, the opportunities to apply for work. Because in general, you know as well that living in New York is better than living in, Missouri or, middle of towns, St. Louis somewhere, right? It's more expensive to live there, but your job opportunities are higher compared to those towns somewhere. Same thing as well if you live in Dublin, if you're in Ireland, again, I keep using where I know, okay? But actually, let's say Nigeria, same thing. If you lived in Lagos and for some reason your family house is in Abuja, or not in Abuja, in Ibadan or Gun State or any of those areas in the middle of nowhere. It's cheaper to live there. Okay, you can buy a house there, but trust me, you only live in Lagos because it's around the corner. You get good quality life. You get more connections. You can then talk to people, go out in the evening, meet people. Okay, and improve your career opportunities there. Then when you're a bit older, you can move out if you wanted to. So paying the rent to live in a city, in a town, I don't think is a waste of money. I think it's a connection that you build to invest in your own future. And then if for some reason you decide to buy, then you better be sure you want to buy. So you want to make sure one, it's in an area you want to live in. You want to make sure it's actually in, a place that you want to live in for the next 10 or generally about 10 to 15 years is where you want to live in those places. Because in truth, if for some reason you move out, then that's a fire sale. If you want to buy or sell at that point, it's it's expensive. So you lose a lot of money in terms of equity. And there's always obviously there's the next question here is, oh my goodness, when you buy a house, you get equity. That's true. That's as much as me. And the way you should treat equity, again, a lot of people talk about these things. Oh my goodness, you can buy equity. The way equity should be, it should be as much as treat equity, right? Taking equity loan on your houses, okay? Treat it as borrowing money or using your salary for something, if that makes sense. Your house is worth 1 million, okay, and you go in and get an equity loan on 100,000. It shouldn't be to buy a house. It shouldn't be to go on holidays because the price could go up or down on that house. In general, it always goes up, okay, that's the truth. But we all know what happens in a few months. The last few years, it hasn't been going up always, indefinitely. That's a silly argument to go with. So what that means then is, guys, please, 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 if you want to take an equity loan on your house, use that for investment. So you want to go in and actually buy more property if you need to, or buy an investment, or buy a property, or buy more things that you actually then build up the equity. And at that point, you're taking a risk, but it's a worthwhile risk. Okay. So thank you very much as we dispel some of those funny rumors and guru talks that's almost wrong, especially as these guys don't know what they're talking about. Be careful and make sure you do your research. Thank you. Bye-bye.